Why did Bitcoin go down? What's going on? Is a dead cat bouncing? No, my dead cat is not bouncing. The Japanese central bank is going to have to tighten rates. And this brings us all the way back to the Fed, the United States, and it helps us understand a lot of the fighting. None of these dips scream Bitcoin's going to 10K. None of these dips are talking about cats. This is all to do with global liquidity. And I know it sounds weird, but what Bitcoin is telling us right now has everything to do with Japan.
Crypto seems to be up for another rough week. In early Asian hours on December 1st, Bitcoin slipped nearly 5%, falling from a consolidation band around $91,000 to the mid-$80,000, as a surge in Japanese government bond yields triggered a broader risk-off rotation. The move erased roughly $150 billion from total crypto market capitalization and exposed how fragile, low liquidity conditions still are at the start of December. According to Strike CEO Jack Mallers, this weakness didn't begin in crypto. It began in Tokyo. Yields on Japanese government bonds just hit their highest levels since 2008, driven by growing expectations that the Bank of Japan may raise interest rates at its meeting later this month. For more than a decade, the yen has powered one of the most influential strategies in global finance: the yen carry trade, borrowing low-yielding yen to fund higher return positions across U.S. equities, emerging markets, and increasingly, Bitcoin. Now that calculus is changing. A stronger yen and rising domestic yields undermine the profitability of that trade, pressuring investors to unwind leveraged positions and reduce exposure to risk assets globally. That unwind doesn't just remove marginal buyers, it forces active selling, especially in highly liquid assets like Bitcoin. We've seen this before. In July-August 2024, a massive unwind of the yen carry trade triggered a brutal global sell-off. The yen surged, markets crashed, and trillions in value were erased globally. In the latest episode of his Mailbag Monday podcast, Mallers argues that the latest drawdown is best understood as a liquidity event, not a sentiment collapse. In his view, Bitcoin is behaving exactly as a global high-beta asset should when funding conditions tighten abruptly. It reprices first, fastest, and most visibly. As yen-funded positions were unwound, Bitcoin became a convenient source of liquidity. Not because conviction has vanished, but because it trades 24/7, offers deep markets, and can be sold immediately to rebalance exposures. In today's video, we'll break down Mallers' full framework, why he still sees long-term structural bullishness for Bitcoin, and the signals he believes matter most in the months ahead. If you're following this market and want clear, macro-driven explanations, hit like, subscribe, and drop a comment below. Let me know whether you think this move is just noise or the start of a larger liquidity cycle shift. Thanks for the support and enjoy the video.
First chapter of this episode, the Bank of Japan, the quiet puppeteer of global risk. So let's talk about Japan's relationship with Bitcoin. So this tweet from Arthur, BTC dumped because the Bank of Japan put December rate hike in play. USD JPY 155 to 160 makes the Bank of Japan hawkish. What is he talking about, and what are you guys looking at? So for those listening on the podcast waves that are not viewing the screen I'm sharing, what we're looking at is, in white, BTC USD, so the price of Bitcoin. And you can see it stagnating sideways, a little bit of up chop, a little bit of down chop, and then it looks like it got shot and fell off a cliff. What are we looking at in orange, weirdly? That is the dollar-yen currency rate. Weirdly, guys, it shows very similar pattern. A little chop, but mostly sideways, and then it looks like it got shot and fell off a cliff at the same exact second. What's going on? What is this relationship? This from Zero Hedge. Central banks have completely messed up market messaging. First, the Federal Reserve's schizophrenic communications sent December rate cut odds from 80%, then to 30%, then 100%. And we've talked about this on the show. December rate cuts for the Fed, for the US dollar, were guaranteed, and then they backed off it, and Bitcoin freaked out, and now they're back to guaranteed. And now the Bank of Japan just sent December rate hike odds to 80%, down from 20% only 10 days ago. So the cost of capital, the cost of money, the price of money, there's really two ways to think about liquidity globally, macroeconomics, fiat. There is one, what is the price of money? And two, what is the supply of said money? Now, traditionally, I'm more interested in the latter, in the supply of said money. Why am I interested in that? Well, we've seen Bitcoin go from 16K to 126K while rates were at 4+% in the United States. And that was on the back of the fastest rate hike ever. And I've explained on the show, the reason Bitcoin was able to rally so much is because liquidity came from the US Treasury. This idea of fiscal dominance. Global sovereigns, and specifically the United States, is so indebted that it has to find liquidity at all costs. It can't solely rely on the Fed anymore. You get this idea of fiscal dominance when the US government is really driving policy for money. So to me, the quantity of money has been more important and will continue to be more important. But the other very important variable is the price of said money. And the price of said money is set by central banks, and that is known as the rate. And so what we're seeing is all of a sudden, Japan went from very likely not to hike rates to very, very likely to hike rates overnight. Now, why is Japan hiking rates relevant to Bitcoin at all? It is so funny typing out these titles like, what does Bitcoin, this magic internet money that this anonymous person leaked on a mailing list, tell me about Japan, this country on the other side of the world, as I sit in Chicago? So I read this tweet. This chart is single-handedly bringing the entire crypto market down. Japan 10-year bond yield is now at its highest level since 2008. Bank of Japan is about to do a rate hike at the next meeting, which will make things worse. Cheap borrowing will be over, and people will sell their assets to repay the debt. Crypto is the most liquid asset, so it's dumping the most. I think we can soon see the impact in other risk assets as well. So this, guys, I'm actually going to skip to this slide. This has happened before to this industry. And I've referenced it, and I want to spend a little bit of time talking about it. It's called the carry trade. The idea is Japan has been the cheapest capital to borrow in the world because rates have been set literally at zero. Sometimes they've been negative, where you get paid to borrow money. And even as they have hiked rates as of recent, the rates are still unbelievably small. Why is that relevant? Well, what the carry trade is you source capital, you borrow money in Japanese markets, in yen, and you invest that money into risk that performs and out-returns the rate. Common thing to do is to borrow yen and buy the Mag 7, buy the S&P 500, buy NVIDIA, buy Bitcoin. You're taking free money. Think about what Michael Saylor has done. What was the innovation initially? He was raising money at 0%. Would you borrow $1 billion if it cost you nothing? Probably. I would. In fact, I am. That's a lot of what 21 plans to do. And so there was what's known as a carry trade. The carry trade is very simply borrow where the capital is cheap. When the US has interest rates at 4+%, that's not cheap. When the yen is at interest rates of 0 or negative, that's cheap. As the yen strengthens, or as the cost of the yen, the cost to borrow strengthens and rates go up, this trade starts to unwind. All of this to say, the reason why the title of this episode is What Bitcoin Tells Us About Japan, the yen is the world's margin loan. The yen has played a very critical part in global liquidity, okay? The yen has supported risk assets very, very, very much so. Where if this trade starts to unwind because Japan has to raise rates, it will be very bad for assets, particularly risk assets. And so as I always say on this show, what does Bitcoin do a phenomenal job at? Telling us the truth. Bitcoin's unbelievable, the best in the world at being a free market that can be honest and that can tell us the truth. What is Bitcoin telling us? Global liquidity, no bueno. So I read the tweet. In July 2024, the Fed cut rates while the Bank of Japan raised rates. leading to the unwind of the carry trade. Bitcoin capitulated into it and found a low 1 week later. Good chance this happens again on December 10th. The Fed cuts and the Bank of Japan raises rates. So maybe Bitcoin finds a low mid-December.
As Mallers points out, these kinds of capitulation events aren't new. They're structural features of a market still tethered to global liquidity cycles. When policy regimes shift, Bitcoin reacts first, fastest, and often most violently. If the Federal Reserve moves ahead with its expected December cut at the same time the Bank of Japan tightens, you get a rare moment where two of the world's most important liquidity spigots turn in opposite directions. That divergence compresses dollar liquidity, strengthens the yen, and forces deleveraging across every part of the risk curve. Maller's view is that Bitcoin's sharp drawdown isn't evidence of weakness, but the result of mechanical positioning being unwound in real time. The same dynamic that set up last year's explosive rally once the flows reversed. But Mallers doesn't stop at identifying liquidity triggers. He's making a broader point about how global macro volatility is colliding with Bitcoin's maturation as a monetary asset. He argues that as traditional funding markets become more unstable, the incentives to move value over open, permissionless rails only strengthen. In his view, what looks like chaos on the surface is actually the early phase of a much deeper transition. Capital moving away from systems constrained by policy decisions and toward systems governed by math and market consensus. This sets the stage for the next part of the discussion, where Mallers shifts from diagnosing the current sell-off to explaining why the broader architecture of global payments, remittances, and dollar settlement is rapidly being rebuilt around Bitcoin-native technology, and why that shift matters even more than short-term price volatility.
The point of this is not to tell you guys Bitcoin's going to find a low in mid-December. I've said it once, I'll say it again. I have no idea what Bitcoin's going to do in the short term. No idea. Nor do I think it's that important. If what Bitcoin's going to do over the next few weeks is that important to you, you should be very careful. You should probably get a little bit more humble and stack a little more sats. But what I think is interesting and what we talk about on the show a lot is understanding the world around us, understanding the indebted sovereigns, understanding how they're printing money, where they're printing money. Because the mainstream media is lying to us, it's really difficult to find a source of truth. And so when you see things like, oh, Bitcoin's run, what do all the traders on Twitter like to say? This is a dead cat bounce. I don't even know what that means. This is a dead cat. Okay, well, listen, and people say, the bull runs over. This is a dead cat. See that cat on the ground? It's dead. Bull runs over. I say, okay, well, no, listen. If the carry trade, if Japan is going to go from 20% chance to raise rates to 80%, and it's going to impact the carry trade, Bitcoin is going to start screaming first because it is the liquidity smoke alarm. It is the only free market. It is the truth source we have globally. That's what's happening. Make no mistake, I don't know anything. I'm allergic to cats. Literally, I am. You learn something new about me every single week. I am physically allergic to cats. I can't be around cats. So I know nothing about a dead cat bouncing. I know nothing about it. So the point is, we're in the middle of a liquidity crunch. Again, that's kind of been my consistent theme, is that today QT ended. So first of all, for all of you, QT ended today, quantitative tightening. Quantitative easing, QE, is very likely to resume in the near term. We're very likely to get rate cuts going forward. Trump now knows, he said and communicated, I know exactly who I want as my Fed chair. We have looser regulations for the banks. They're going to be allowed to use unlimited leverage for treasuries, create a lot of credit, create a lot of new money. We have 50-year mortgage. We have stimulus checks. We have midterms. I think that the liquidity cycle at the central bank level is bottoming out. It's about to turn back up. We have been tightening monetary policy for years now. And despite that, Bitcoin's been able to make new highs. And again, that's because of the level indebtedness and the fiscal dominance. When you combine the two, I stand by it. I know I take a lot of shit for it. I continue to say, I think this cycle is 250K to $1 million. Sue me. And if I'm wrong, then yeah, we're looking at a dead cat that's bouncing or whatever, and the cycle's over. I fundamentally disagree with that. My dead cat is not bouncing. The Japanese central bank is going to have to tighten rates. And this brings us all the way back to the Fed, the United States, and it helps us understand a lot of the fighting. So I'll read this last slide. We've gone from guaranteed December cut a month ago to not cut last week, back to a likely cut now, all without any meaningful new economic data as the shutdown fallout continues. The Fed's communication process seriously needs to be revamped. This is absurd. And so if you guys want to understand why Donald Trump, why Scott Bessent, why these guys have been aggressively campaigning for a lower rate, a lower Fed rate, and more aggressive monetary policy, is because they need a weaker dollar. They really desperately need the dollar to weaken and for the Fed to cut if Japan is going to have to hike. They need looser monetary policy. It's really going to take a very tightly correlated effort from the Fed and from the U.S. Treasury to financially engineer their way out of this with the least amount of pain. There will be pain, undoubtedly. There has to be pain. The question is how much, and the question is to who. And the question they're asking themselves is, can we get reelected despite it? And so my expectation is, well, first of all, we'll see how the next week plays out. Bitcoin is front-running risk assets. If Bitcoin remains this low and liquidity is not injected and the Bank of Japan does not revert on the expected rate hike and nothing gets aggressive on the U.S. side, the stock market will melt down and will fall as well. All risk. Everything got murdered, guys. Stock market down, NASDAQ down, everything down. Everything down. And again, this is not voodoo magic. These are not dead cats. And so we will see how long this is allowed to persist for. But my message continues. Buy every dip. The United States cannot afford to have assets go down over a persistent time frame. The U.S. stock market is a Ponzi retirement account for the United States. They need it to both store wealth for Americans and for Americans to monetize wealth where they earn tax receipts. If the U.S. doesn't have a stock market that's up 10 to 15% a year, it is insolvent because it cannot afford the interest payments on its debt. So all dips should be bought. We are living through a prolonged fiscal dominant cycle. None of these dips scream Bitcoin's going to 10K. None of these dips are talking about cats. This is all to do with global liquidity. And I know it sounds weird, but what Bitcoin is telling us right now has everything to do with Japan.
When interest rates shift in Tokyo or Washington, the response in Bitcoin is now immediate, measurable, and globally synchronized. That level of sensitivity is something you typically see only in established macro assets. For Mallers, this is proof that Bitcoin is no longer a speculative corner of the market. It is becoming part of the machinery that responds to changes in global liquidity cycles. And the more it matures, the more those cycles will define the path forward. He also highlights an underappreciated dynamic. The infrastructure layer is evolving faster than the market narrative. While headlines focus on price swings, Strike is expanding access to low-cost remittance rails, enabling dollar-stable transfers across continents, and integrating Bitcoin settlement into markets that have historically been locked out of the global financial system. That real-world utility quietly strengthens Bitcoin's monetary credibility, because every corridor that moves from legacy rails to Lightning reduces friction, expands liquidity, and increases the asset's relevance outside speculative trading. In this framework, the short-term sell-off becomes almost irrelevant compared to the structural trend. If the yen carry unwinds, liquidity contracts, and Bitcoin sells off into mid-December, Mallers sees that as a temporary mechanical reset, not a violation of the broader thesis. The real story, he argues, is the ongoing migration of global value transfer to open networks, and the fact that every policy misstep by central banks accelerates that migration. Markets may panic, but the underlying adoption curve remains intact and, in many places, is accelerating. If you're finding this breakdown helpful, make sure to like the video, subscribe for more deep dive macro and Bitcoin analysis. Thanks for watching.